Hey, welcome back. If you've ever looked at someone who built real wealth and wondered, how did they do that? Chances are the stock market played a big role. But here's the thing, most people never invest. Not because they don't want to, but because nobody ever explained it to them in plain language. It feels complicated, it feels risky, it feels like something only Wall Street guys in expensive suits do. Today we're going to change that. In the next 15 minutes, I'm going to walk you through everything you need to know to start investing in the stock market. What it actually is, how to pick your first investment, and the mistakes you absolutely need to avoid. Whether you have $100 or $10,000, this video is for you. Let's get into it. Let's start with the basics. What is the stock market? Think of it like a giant marketplace. But instead of buying fruits and vegetables, people are buying and selling tiny pieces of ownership in companies. These tiny pieces are called stocks or shares. When a company wants to raise money to grow, maybe they want to build a new factory, hire more staff, or launch a new product, they offer pieces of their company to the public in exchange for cash. Once those shares are out there, people can buy and sell them freely. The price of a stock goes up when more people want to buy it and goes down when more people want to sell it. Simple supply and demand. Now here's the exciting part. When you own a share of a company, you own a real piece of that business. If the company grows and becomes more valuable, so does your share. That's how investors build wealth, by owning pieces of great companies over time. The stock market is not gambling, it's ownership. And historically, the stock market has returned an average of around 10% per year over the long term. That means money invested wisely grows over time, much faster than a savings account ever could. Let me show you something that changed how I think about money forever. It's called the power of compound interest. Let's say you invest $5,000 and never add another dollar. At a 10% average annual return, after 10 years you have around $13,000. After 20 years, around $33,000. After 30 years, almost $87,000. You put in $5,000. You got back $87,000. You didn't do anything extra. Your money did the work for you. Now compare that to a regular savings account, which today gives you maybe 0.5% interest. That same $5,000 after 30 years, just over $5,800. That is the difference between investing and not investing. That is the cost of waiting. The single biggest financial mistake most people make is starting too late. The earlier you start, even with small amounts, the more time your money has to grow and multiply. Before we talk about how to actually invest, let me quickly cover some terms you will hear all the time. Stocks, a share of ownership in a single company. Buying Apple stock means you own a small piece of Apple. Bonds. When you buy a bond, you are lending money to a company or government and they pay you back with interest. Safer than stocks, but lower returns. Index fund. Instead of buying one company, an index fund lets you buy a tiny piece of hundreds of companies all at once. For example, an S&P 500 index fund owns shares in the 500 largest companies in America. Instant diversification in one single purchase, ETF, or exchange traded fund. Very similar to an index fund, but it trades on the stock market like a regular stock throughout the day. Portfolio. This is just the collection of all your investments. Your portfolio might include stocks, bonds, and index funds all together. Dividend. Some companies share a portion of their profits with shareholders regularly. These payments are called dividends. It is basically getting paid just for owning the stock. Bull market means prices are rising and things are going well. Bear market means prices are falling. Both are completely normal parts of the cycle, and both are temporary. Now that you know the language, let's talk about how to actually get started. Here is your step-by-step roadmap. Step 1. Get your finances in order before you invest a single dollar. Make sure you have an emergency fund, at least 3 to 6 months of living expenses saved in cash. This is your safety net, so you never have to sell your investments in a panic when life happens. Also, pay off any high-interest debt first, especially credit cards. If you are paying 20% interest on debt, investing for a 10% return does not make sense. Clear the debt, then start investing. Step 2. Set your goal. Ask yourself why you are investing. Is it for retirement 30 years away? To buy a house in 5 years? To build passive income? Your goal determines how long your money stays invested. The longer your time horizon, the more risk you can afford to take, because you have more time to recover from any dips in the market. Step 3. Open a brokerage account. A brokerage is simply a platform that allows you to buy and sell investments. Think of it as your investment bank account. Popular options include Fidelity, Charles Schwab, and Vanguard, all trusted, beginner-friendly platforms with no account minimums and very low fees. Opening an account takes about 10 to 15 minutes online. If you're investing for retirement, look into opening a Roth IRA or traditional IRA. These are special tax-advantaged accounts that let your money grow either tax-free or tax-deferred. It is one of the best deals in personal finance, and most people never take advantage of it. How to actually use a stock market platform. Let me walk you through what it actually looks like when you open a brokerage app for the first time. Once your account is set up and you have added money to it, you will see a search bar at the top, just like Google. Type in the name of the stock or fund you want to buy, for example, VOO or Apple, and it pulls up the listing. You will see the current price, a chart showing how it has moved over time, and a button that says Buy. You click that, enter how many shares you want or how many dollars you want to spend, and then confirm the order. That is it. The whole process takes about 60 seconds. Most platforms like Fidelity or Schwab also have a watchlist feature where you can save stocks you are interested in and track their prices before you decide to buy. You do not need to understand every number on the screen when you start. Just focus on searching, buying, and holding. Everything else you will learn naturally over time as you get comfortable with the platform. Step 4. Choose what to invest in. Here is my honest advice for beginners. Start with index funds or ETFs. Picking individual stocks takes a lot of research, time, and experience. And even the professionals, hedge fund managers, Wall Street analysts, most of them fail to beat the stock market average over the long run. Studies have proven this over and over again. So instead of trying to pick winners, just buy the whole market. An S&P 500 index fund gives you exposure to 500 of America's biggest, most successful companies. Apple, Microsoft, Amazon, Google, all in one simple investment. Two of the most recommended funds for beginners are VOO, which is the Vanguard S&P 500 ETF, and FXAIX, which is the Fidelity 500 Index Fund. Low fees, broad diversification, strong long-term track record. Step 5. Invest consistently using dollar cost averaging. Do not try to time the market. Nobody can consistently predict when prices will go up or down, not even the experts. Instead, invest a fixed amount on a regular schedule, say $200 every month, no matter what the market is doing. When prices are high, your $200 buys fewer shares. When prices are low, your $200 buys more shares. Over time, this averages out your cost and reduces your risk. The habit of investing consistently every month is more powerful than any stock tip you will ever hear. Now let's talk about risk, because this is where a lot of people get scared and make bad decisions. Yes, the stock market goes up and down. In any given year, your portfolio might drop 10%, 20%, even 30%. That is normal. That has happened many times throughout history. And every single time, the market eventually recovered and went higher than before. The key is understanding that short-term drops are the price you pay for long-term growth. If you invest money you will not need for 10 or more years, short-term dips do not hurt you, unless you panic and sell. Your risk tolerance depends on two things. First, your time horizon. The longer you plan to stay invested, the more risk you can handle. Second, your emotional tolerance. Can you watch your portfolio drop 30% without panicking? Be honest with yourself. A simple rule of thumb. Subtract your age from 110. That gives you a rough percentage to keep in stocks. If you are 30 years old, that is about 80% stocks and 20% bonds. As you get older and closer to needing the money, you shift more towards safer investments. Now let me save you some serious money by telling you exactly what not to do. Mistake number 1, trying to time the market. Waiting for the perfect moment to invest usually means you never invest at all. The best time to start is as early as possible. The second best time is today. Mistake number 2, panic selling during a crash. When the market drops, your gut screams sell everything. That is almost always the wrong move. Market crashes are temporary. Selling turns a paper loss into a permanent one. Mistake number 3, putting all your money into one stock. Diversification protects you. If one company fails, a diversified portfolio barely feels it. Mistake number 4, chasing hot tips and trends. By the time a stock is all over social media and everyone is talking about it, the big gains are usually already gone. Be careful with hype. Mistake number 5. Ignoring fees. A fund charging 1% per year versus one charging 0.03% might sound like a small difference, but over 30 years, those fees can cost you tens of thousands of dollars. Always check the expense ratio before you buy. Mistake number 6. Not starting because you think you need a lot of money. Many platforms today let you start with as little as $1. The amount matters far less than building the habit. Here is the truth that separates successful investors from everyone else. It is not about being the smartest person in the room, it is about having the right mindset. Successful investors think in decades, not days. They do not check their portfolio every hour. They invest in quality assets and let time do the heavy lifting. Warren Buffett, arguably the greatest investor of all time, has said that his favorite holding period is forever. He buys great companies and holds them. That is it. No complicated strategies, no daily trading, just patience. You do not need to be a genius. You do not need to watch financial news every morning. You need patience, consistency, and the ability to stay calm when everyone else around you is panicking. Invest regularly. Diversify. Keep your fees low. Do not panic sell. Repeat for 20 years. It really is that simple. The people who build wealth through the stock market are not smarter than you. They just started, stayed consistent, and did not quit when things got uncomfortable. So let's recap what you learned today. The stock market lets you own real pieces of real companies and grow wealth over time. Compound interest means that starting early, but even with small amounts, is the single most powerful thing that you can do. Open a brokerage account, start with index funds, and invest a fixed amount every single month. Manage risk by diversifying and staying calm during downturns. And avoid the 6 common mistakes that cost beginners thousands of dollars. That is it. You now know more about investing than the majority of people walking around today. If this video helped you, hit the like button and subscribe because we drop new videos every week on building real financial freedom. And leave a comment below. Are you already investing, or is this your very first step? I want to know where you are starting from. See you in the next one.